Hello everyone, welcome to EduTap and welcome to Finance 360-degree session. In today's session, we are going to discuss one very important RBI notification and one very important RBI press release. So these are the two news articles that we are going to discuss in today's session. The first one is regarding the new directions of the Reserve Bank of India in regards to the prepayment charges. Okay, so this is very important. We will discuss that in which loans the prepayment charges will not be levied and till what limit. Okay, the second news article is regarding the India's international investment position. So the yearly data has been released, so that we have to discuss, and we have to discuss the data points that are in news from this data. So all of this we are going to discuss in today's session. But before starting with the session, do subscribe to the YouTube channel of EduTap so that you continue getting these relevant videos, and do join our Telegram channel where you will get the PDF of the session, and the link for the Telegram channel is provided in the description box below. Okay, so let's start with the first news article regarding the RBI, which has released the prepayment charges on loans directions 2025. Okay, so these are the new directions that the RBI has released. Okay, so first of all, why there was the requirement of releasing these directions? So availability of easy and affordable financing to micro and small enterprises is of huge importance. Okay, so basically the micro, small and medium enterprises, they are called the backbone of our country. Why is it so? Because the micro, small and medium enterprises, they have the capacity to utilize the labor force of our country. Okay, they have the capacity to use the labor force or to absorb the labor force of our country, because the large enterprises, they usually have more capital intensive techniques, or they have the automotive techniques that they are using. Okay, the service sector is not able to generate much of the employment opportunities, so it is the MSMEs that is said to have the capacity to absorb the labor force of our country. Okay, so the MSMEs, they are the backbone of our country. They help in huge exports from our country, they help in the production, and the MSMEs can get established in the nook and corner of our country. So you can understand that the MSMEs, they can start production, or they can absorb the labor force in the nook and corner of the country. So the micro, small and medium enterprises, they are of huge importance, and the availability of easy and affordable financing to the micro and small enterprises, the small vendors, the small businesses, they require the affordable financing and the easy financing. Okay, now however, the Reserve Bank has noticed that through the Reserve Bank supervisory reviews, these has indicated the divergent practices, the different practices the different regulated entities are following in regard to levy of the prepayment charges in case of the loans that is sanctioned to the micro and small enterprises, which lead to customer grievances and disputes. So basically, the different regulated entities, the different banks, the different NBFCs, they are following different practices in regards to the prepayment charges, okay, on the loans. That means, let's say you have taken a loan and the loan tenure is of 10 years, but let's say after 5 years you want to close this loan, because let's say you have got the money by selling your property, or you have got the money through some means, and you want to repay the loan, you want to do the prepayment, but let's say the bank is levying heavy charges on you. So this is the problem that the MSCs are facing, the micro, small and small enterprises are facing, that if they try to prepay the loans, they are faced with the heavy prepayment charges. Okay, and this leads to the customer grievances and disputes between the micro, small enterprises and the banks or the NBFCs and such. Okay, so RBI wants that there should be smoother process for the micro and small enterprises to take the loans from the banks and NBFCs and to do the prepayment if required. Okay, but the RBI at the same time do not want the banks to make losses, because the banks also have to sustain their business, right? So the RBI has found a middle way through this RBI prepayment charges on loans, where the RBI has provided certain guidelines that will help the micro and small enterprises, as well as it will help in the sustenance of business of the banks. Okay, so let's understand the guidelines so that you have the clear idea that what RBI is saying and how it will help the banks as well as the micro, small enterprises. So now, certain regulated entities have also been found to include restrictive clauses in the loan contract or agreements to stop the borrowers or to deter the borrowers from switching from one lender to another. Let's say you have taken the loan from a lender XYZ. Now you find that, okay, the second lender is providing better services, okay, and the second lender is providing the loans at the lower interest rate or at better terms and conditions, at good terms and condition. So you want to switch your loan from one lender to another. Now it has been found that many of the regulated entities, they have the restrictive clause in loan contracts or agreements that deter the borrowers from switching over to another lender, either for availing the lower interest rate or the better terms and conditions. Okay, so this is the idea that the banks, many of the banks or NBFCs, many of the regulated entities, it has been seen that they are following divergent practices in regards to the prepayment charges that they are levying on the micro and small enterprises, that is stopping the micro and small enterprises to do the prepayment of the loans, as well as the banks or NBFCs, they are also having restrictive clauses due to which the micro and small enterprises are not able to shift from one lender to another lender. Okay, so these are some of the things that were found in the Reserve Bank supervisory reviews. So as announced in Statement on Developmental and Regulatory Policy document dated October 9, 2024, a draft circular was prepared and this was issued, the draft circular was prepared and this was issued on February 2025 for public consultation, and now the RBI has got feedback from the market participants, from the stakeholders, and now the RBI has released the final directions. So now let's see that what are these final directions. Okay, so now let's move forward with the details. First of all, based on a review of the supervisory findings and public feedback received on the draft circular, the RBI has released the final guidelines. So hereby RBI issues the directions. Okay, now these directions shall be called the Reserve Bank of India Prepayment Charges on Loans Directions 2025. Now these directions shall be applicable to all the loans and advances that is sanctioned or renewed on or after January 1, 2026. So if the loan is sanctioned or the loan is renewed on or after January 1, 2026, so they will follow these loans, these advances will follow the new directions. Okay, these directions. So now let's understand the applicability of the directions. So these directions shall apply to all the commercial banks excluding the payment banks, because the payment banks, they do not provide the loans or advances. Okay, so all the commercial banks excluding the payment banks and including the cooperative banks, NBFCs and all India financial institutions. So these directions apply to all the commercial banks, cooperative banks, NBFCs, all India financial institutions excluding the payment banks. Okay, so now coming to the next point, that an RE, the regulated entity, let it be the NBFCs, the commercial banks, cooperative banks, so the regulated entity shall adhere to the following directions regarding the levy of prepayment penalty or prepayment charges on all the floating rate loans and advances. So basically the directions that the RBI has released, this will be followed on all the floating rate loans and advances. So why the directions will only be followed in the floating rate loans? Why not on the fixed rate loans also? So try to understand that the floating rate loans, they do not have a fixed yield for the bank. They do not have a fixed return for the bank, because if the borrower has taken the floating rate loan, that means currently, as on the basis of the market condition, the interest rate is 6% that the borrower has to pay. Now let's say because of the market conditions, the interest rate is increasing and the borrower now has to pay 10%. Or let's say because of the market conditions, the interest rate is decreasing and now the borrower has to pay 4.5% of the interest rate. So floating rate loan means that here the interest rate is fluctuating on the basis of the market conditions. So the rate is floating. Fixed rate loan means, let's say a borrower has taken a loan with the fixed rate at let's say 5% or let's say 15%. Okay, so this is the interest rate that is decided. And the borrower has agreed that the borrower wants to take the fixed rate loan. Even if the interest rate is in the market is increasing to 18%, the borrower will only have to pay 15%. Even if the interest rate is decreasing to 12%, the borrower has to pay 15%. So here you can understand that the fixed rate loan means that the interest rate or the return for the bank has been locked in. Now the bank is expecting this much return of 15%. So fixed rate loan, this is the loan where the interest rate cannot change or where the interest rate do not change on the basis of the market condition, and the bank expect a particular interest rate from the loan. Okay, so now these kind of directions, that is the prepayment charges directions, they will be followed on the floating rate loans and advances and not on the fixed rate loans and advances. Okay, so why is it so? Let's try to understand this. Okay, so here So the floating rates, they have no locked in yield for lenders. So in the floating rate loans, the interest rate is fluctuating. That means the returns for the bank is fluctuating. The bank is not expecting any particular percentage of yield, or the bank is not expecting any particular rate of returns. Okay, the floating rate loans, it might provide more returns to the bank if the interest rate is increasing in the market, or it can provide lower returns to the bank if the interest rate is decreasing. That will be according to the market conditions. Okay, now in the fixed rate loans, the banks expect a particular interest. Okay, let's say the fixed rate loan has an interest rate of 12% or the interest rate of 8%. So the bank will expect that this is the interest rate, or this is the percentage of returns that the bank will be getting on the yearly basis or on the half yearly basis. So in the fixed rate case, the bank has a locked in interest, or the bank has a locked in return that the bank is expecting, and the bank has made the future plans as per the returns that it is expecting. Okay, now let's take an example so that you are able to understand this better. Let's say the loan amount is of 10 lakh and the tenure of loan in which the repayment has to happen is 5 years. Okay, so the tenure of loan is 5 years. The fixed interest rate is 12% per annum. So the bank is expecting the 12% of returns every year for 5 years. Okay, now let's say the 2 years have passed in which the borrower has paid 12% of interest rate. Now the tenure was of 5 years, 2 years have passed, so 3 years are left. Now the market rates are falling down and the market rates have come to 9%. Now the borrower is going to the bank that, okay, I do not want to continue with this loan and I want to prepay the loan. So you can understand that now the borrowers want to prepay the loan in full. The borrower do not want to carry on with the loan. So here you can understand that the bank was expecting 12% of returns every year for 5 years. Okay, and the bank had made the future plans according to the returns that it is expecting to get on the fixed loan. Now after 2 years, the 3 years tenure is left. And the borrower is saying that he wants or she wants to prepay the loan. Now currently the market rate is 9%. So now if the bank gives the new loan, now let's say the bank has allowed the prepayment of loan and the bank is giving the new loan, so the bank will be giving the loan at 9% or around 9%. So bank will be making the loss of 3% every year for the coming 3 years, because the bank was expecting the 12% of returns for 5 years. 2 years have passed. Now for coming 3 years, the bank was expecting 12% of the returns, but the prepayment of loan has happened, and now the bank can only get 9% of returns when the bank gives a new loan at the new market condition with the new interest rate in the economy. Okay, so new loan will have 9% only of the interest rate of the returns to the bank. So bank will make a loss of 3% each year in this kind of condition. That's why it is said that if the bank charges the prepayment in case of fixed loans, so that should be decided by the bank. So bank itself, the bank, if it is allowing the prepayment of the loans, if the bank is allowing the prepayment of loans in case of fixed rate loan, the bank can decide the prepayment charges on the basis of the board policy. Okay, so this is the idea, because bank makes losses if the prepayment happens on such loans that have fixed rate of interest. So on such loans, if the prepayment is happening, so the bank is making the losses, and that's why it is allowed for the bank to charge the prepayment charges on the prepayment of the loans with the fixed interest rate, so that the bank can cover some of the losses. So this is the idea. That's why these directions are for only the floating rate loans and advances, because in the case of floating rate loans and advances, let's say the floating rate is the changing loan rate. Okay, so let's say the borrower is saying that I want to do the prepayment of the loan, I want to close this loan, and the lender will easily allow this closing of the loan, because the lender can give the new loan at the current market determined interest rate, or the lender can give the new loan as per the current market conditions, because anyway the floating interest rate loans have the fluctuating interest rate. So the lender will not make loss in this case. So in the floating rates, no locked in yield for lender. The lender do not have a fixed returns or fixed yield. The yield keeps on changing as per the market conditions. So there is no justification for penalty in the case of floating rate loans. So there is no justification for penalty as such. Okay. And the lender can easily allow the prepayment of loans without any penalty, without any requirement of the penalty. Okay, but in the case of fixed rates, the lender has a locked in yield, has a definite returns that the lender is expecting. If the prepayment happens, in this case the lender might make the losses, and if the lender is making the losses, to cover that losses, the lender is allowed for the prepayment charges. Okay, that's why these regulations, these directions on the prepayment charges that the RBI has imposed, they are imposed only on the floating rate loans and advances. So now what are the directions? Let's try to understand this. For all the loans granted for purposes other than business to individuals with or without co-obligant, and regulated entity shall not levy prepayment charges. So try to understand that if the loans are granted for the purposes other than business, so that means if the individuals are getting the loan for non-business activities, so the individuals, they will not be levied with any prepayment charges. They will not be levied with any prepayment charges. So for all loans granted for the purposes other than business, so to the individuals with or without co-obligant, and regulated entity shall not levy prepayment charges. So this is in case of floating rate loans, because as I have told you that in the case of floating rate bond, even if the prepayment is happening, so the bank is not making any loss, because the bank can give, let's say the borrower has done the prepayment, the borrower has returned the 10 lakh rupees. So the bank can use this 10 lakh rupee to give the new loan at the current market interest rate. So the bank will not be making any loss, because anyway the borrower had a floating rate of interest where the borrower had to pay the floating rate of interest, the market determined rate of interest, or the rate of interest on the basis of the market conditions. Okay, so this is the idea. So now see, for all loans granted for business purpose to individuals and micro and small enterprises with or without co-obligant, so in this case a commercial bank, excluding the small finance bank, regional rural bank, local area bank, so a commercial bank excluding these banks, and a tier 4 primary urban cooperative bank, and the NBFC upper layer, and all India financial institution, they shall not levy any prepayment charges. So that means that if the prepayment is done by the individual and the MSE, micro and small enterprise, in case of the loan that has been taken for the business purpose, so no prepayment charges will be levied by these entities. Okay, so the NBFC upper layer, I hope you know that the NBFCs are divided into 4 layers: the base layer, middle layer, upper layer, and top layer. So NBFC upper layer are the big NBFCs, as well as the urban cooperative banks are also divided in between tier 1 urban cooperative banks, tier 2, tier 3, and tier 4 urban cooperative banks. So tier 4 are the big urban cooperative banks. So the big institutions, they do not have to, or they should not levy the prepayment charges. They shall not levy the prepayment charges in case for the loans, that is the floating rate loans that is granted for business purpose to the individuals and micro and small enterprises. A small finance bank, a regional rural bank, tier 3 primary urban cooperative bank, state cooperative bank, central cooperative bank, and NBFC middle layer, they shall not levy any prepayment charges on loans with sanctioned amount or limit up to 50 lakh rupees. Okay, so this is the limit that the small finance bank, regional rural bank, tier 3 primary urban cooperative bank, and the central cooperative bank, state cooperative bank, NBFC middle layer, they shall not levy any prepayment charges on the loans that is sanctioned amount limit up to 50 lakh. Okay, so this is the idea. Now the direction shall be applicable irrespective of the source of funds. That means, let's say the borrower is borrowing from some other entity, and through that the borrower is doing the prepayment, or the borrower has taken the money from their relatives, or the borrower has got the money from some export activity or from some trading activity, doesn't matter. From wherever the borrower has got the money, the borrower can use that money to do the prepayment of the loan. Okay, so irrespective of the source of funds, the funds can be used for prepayment of the loans, and there is no minimum lock-in period. So before, what used to happen, that the banks used to say that okay, if the tenure of the loan is 10 years, for the first 12 months, that is for the first year, the prepayment of the loans cannot happen. But now the RBI has said that in case of floating rate loans and advances, there will be no minimum lock-in period. There will be no minimum lock-in period for the prepayment of the loan, and the prepayment of the loan can happen even after 3 months, 4 months, or whenever the borrower wants. Okay, applicability of the above directions for dual or special rate. So what happens that in some cases, in some loans, let's say it is said that for the initial 3 years there will be floating rate that will be levied, and for the rest of the 5 years, let's say the loan tenure is 7 years, so rest of the 5 years the fixed rate of the loan will be revied. Okay, so in case the dual or special rate is used for the loan in which there is combination of fixed and floating rate, so loans will depend, so the prepayment will depend on, the prepayment charges will depend on that whether the loan was in the floating rate category when the prepayment of the loan is happening, or whether the loan is in the fixed rate category. So let's say the prepayment is happening in the initial 1 year itself. So you can understand that in this time period, in the starting 3 years, the loan is in the floating rate category. Okay, so the bank has to treat it as a floating rate loan, and then the prepayment charges will not be levied if these are the limits that are being followed. Okay, so applicability of above directions for dual or special rate loans will depend on whether the loan is on the floating rate at the time of prepayment, and if the loan is on the floating rate category during the time of the prepayment, then these directions will be followed. Okay, next is in cases other than those mentioned in the paragraph 5.1 or 5.2. so in case other than those mentioned in these paragraphs, prepayment charges, if any, that is prepayment charges in the case of fixed rate loans, or the prepayment charges for the loans that is taken from small finance banks, regional rural banks, that is more than, that is above the limit of 50 lakh. So in these cases the prepayment charges can be levied, and if any prepayment charges are being levied, that shall be as per the board approved policy of the regulated entity. However, in case of term loans, that means the loans that have a time period, let's say 7 years, 10 years, 5 years, 2 years. So in case of term loans that have a definite time period, the prepayment charges, if levied by the regulated entity, shall be based on the amount being prepaid. Okay, let's say the loan was of 10 lakh rupees and the 2 years have passed. So let's say 3 lakh has been paid in this 2 years. Now the left out amount that is getting prepaid is 7 lakh. Okay, so the prepayment charges can only be levied on the amount that is getting prepaid, so this 7 lakh rupees, okay, that is getting prepaid, only on this the charges can be levied. In case of cash credit or overdraft facilities, that is a kind of revolving credit kind of thing, revolving credit, where the borrower can keep on taking the loan. Let's say you have got the facility that because you are a very good customer of the bank, so you have got in your account, you have got the revolving credit limit of 2 lakh rupees, or you have got the cash credit or overdraft facilities of 2 lakh rupees. Okay, but in case of cash credit or overdraft facilities, the prepayment charges on closure of the facility before the due date shall be levied on amount not exceeding the sanctioned limit that is sanctioned to you, that is the amount that is provided to you. Only on that amount the prepayment charges can be levied in case you are closing the facility before the due date. Okay, now in case of cash credit or overdraft facilities, no prepayment charges can be levied if the borrower has already informed the regulated entity of his or her intention not to renew the facility before the period as stipulated in the loan agreement, provided that the facility gets closed on the due date or before that. Okay, regulated entity shall not levy any charges where the prepayment is effected at the instance of the regulated entity. That means if the regulated entity is demanding the money beforehand and the borrower is agreeing with the regulated entity, so that means if the prepayment is affected at the instance of the regulated entity, that means the regulated entity has initiated the prepayment request. So in this case, the prepayment charges cannot be levied. Okay, the applicability or otherwise of prepayment charges. So the applicability or otherwise of the prepayment charges, let's say in the case of fixed rate loans, if the prepayment charges will be levied. So in this case, this should be clearly disclosed in the sanction letter and loan agreement, and in the case where the key fact statement is being provided, these prepayment charges shall also be mentioned in the key fact statement. Okay. So now let's understand the next point, that is the regulated entity shall not levy any charges or fees retrospectively at the time of prepayment of the loans. So that means, let's say you have taken a loan from a bank, and the bank, while the bank was giving you the loan, the bank waived off the processing fees. That means the bank said that, okay, we are not taking the processing fee because you are a loyal customer, or let's say you have taken the loan and you have done the payments of the loan on the timely basis with the same bank. So the bank is waiving off your processing fee when you took the loan. Now let's say after the loan tenure was of 5 years, and after 2 years you want to do the prepayment of the loan, or you are closing the loan now. Okay, so the regulated entity now shall not levy any charges or fees retrospectively at the time of prepayment of loan. That means it's not like that now during the prepayment of the loan the bank will say that, okay, you have to give the processing fee that we waived off 2 years back, or that we waived off when we gave you the loan. So that the bank cannot do. Okay, so regulated entity shall not levy any charges or fees retrospectively that the bank had earlier waived off at the time of prepayment of loans which were waived off earlier by the regulated entity. Okay, with the issue of these directions, the instructions that were earlier issued, so they have been repealed from the effective date of these directions, that is 1st January 2026. Okay, all the repealed circulars shall be deemed to have been in force during the relevant periods prior to the coming into effect of these current instructions. So when these instructions will come into effect, the earlier instructions will be repealed. That is the basic idea. Now, as I've told you that the urban cooperative banks are divided into tier 1, tier 2, tier 3 and tier 4. So tier 4 UCBs are the ones that have the deposit more than 10,000 crores. Tier 3 UCBs are the ones that have the deposit more than 1,000 crores and up to 10,000 crores. Okay. For the NBFCs, if you want to see the criteria for the base layer, middle layer, upper layer and top layer, so in this case do see the scale based regulatory framework of the NBFCs, because there are various criteria that are present. Okay. Now coming to the next news article, that is India's international investment position during April-March 2024-25. So during the 2024-25, the net claims of non-residents have declined. Okay. So basically what has happened, that during the period of April 2024 to March 2025, in this time period, the overseas financial assets of the Indians have increased more than the overseas financial liabilities of our country. Okay, so the India's external financial assets have increased by $105.4 billion, while the liabilities overseas, or the India's external financial liabilities, have increased by $74.2 billion. So in this time period of April 2024 to March 2025, the India's external financial assets have increased more than the India's external financial liabilities, due to which the net claims of the non-residents have declined. Okay, so basically our assets, the external assets, have increased more than the external liabilities. Okay, due to which the net claims of non-residents have declined by $31.2 billion. So basically the net claim of non-residents have declined because of the higher increase in the India's external financial assets as compared to the external financial liabilities. Over 72% of the rise, over 72% of the increase that we have seen in the India's overseas financial assets was due to increase in the overseas direct investment, that is the foreign direct investment that the Indian investors are doing in the other countries. So over 72% of the rise in the India's overseas financial assets, the assets that we have in the other countries. So over 72% of the increase that we have seen in the assets in the other countries is due to the increase in the foreign direct investment done by the Indian investors in the other countries. The currency and deposits, the deposits that is done in the other countries. So Indian investors or the Indian people, they are doing the deposits in other countries also. And the reserve assets, the reserve asset is the asset in the foreign exchange reserves. So basically the reserve assets, they are the foreign exchange reserves that are held with the Reserve Bank of India. So the foreign exchange reserves, the reserve asset has also increased with the Reserve Bank of India. So over 72% of the rise that we have seen in India's overseas financial asset was due to the increase in overseas direct investment, that is done by the Indian investors, currency and deposits that the Indian people are doing in the other countries, the deposits that we are doing, and the reserve asset with the Reserve Bank of India. So in the foreign exchange reserves, the RBI has the foreign currency account, the RBI has this SDR, special drawing rights and such. So the reserve asset with the RBI has increased, due to which also the India's overseas financial assets have increased. Okay. Now inward direct investment. So we have discussed about that how much investment we have done in the other countries, what is the increase in the overseas financial asset. Now let's talk about the overseas financial liabilities. That means how much investment the other countries have done in our country. So inward direct investment, that is the foreign direct investment that is done by foreign investors in our country. So that has increased. Loans as well as currency and deposits. So we are getting more loans from the other country. So that is the liability, overseas financial liability that we have, because we have to return the loans. The foreign people or the non-resident Indians, the foreigners, they have deposited their money in our country. So we have to return those deposits when the deposit is demanded. So we have to return the deposit. So this is the liability. So this is the foreign liability. Okay. So inward direct investments, that is the investments that are done by the foreigners, the loans that are coming from the foreign countries, the deposits that are coming from the foreign countries or from the NRIs or from the foreigners. So those are the liabilities, and these account for over 3/4 of the rise that has come in the foreign liabilities during the year. So the increase that has come in the financial liabilities or the foreign liabilities, that is because of the inward direct investment, the foreign direct investment from the foreigners, the loans and currency and deposit. Okay. Now the ratio of India's international financial asset, the international financial asset divided by the international financial liability, increased to 77.5% in March 2025 as compared to 74.1% a year ago. So the ratio of India's financial asset to India's financial liabilities have increased to 77.5%. So here you can see that the assets from March 2024 to March 2025, because we want to see the yearly data. So if we see the yearly data, you can see that the assets have increased to $1139.2 billion from $1033.8 billion. So that means there is $105.4 billion of the increase in asset. So the assets have increased by $105.4 billion in the financial year April to March 2024-25. So from the previous year to this year, the assets have increased. The overseas financial asset or the external financial assets have increased by 105.4 billion, as well as the liabilities. You can see the liabilities have increased from 1395.0 to 1469.2. So the liabilities have increased by $74.2 billion. Okay. So this is the increase that we have seen in the liabilities, in the external financial liabilities, that have increased by $74.2 billion. But still you can see that the liabilities, if we see in the total liabilities, so we have seen the increase that has happened in the liabilities and the increase that has happened in the assets, in the financial assets, overseas financial asset. Now if we see the total amount of assets and the total amount of liabilities, so the liabilities are more than the assets, and that's why the net India's international investment position, the net IIP, is in negative of $330 billion, which is lesser than $361.2 billion a year ago. So this is the idea. Okay. Now coming to ratios of external financial asset and liabilities to GDP. So basically the overseas asset as a percentage of GDP is 29.3%. So overseas asset is 29.3% of the GDP, and the overseas liability or the external liability is 38.0% of GDP. Now here you can see that overseas asset have increased from the previous year. The overseas asset have increased from the previous year. So overseas asset as a percentage of GDP has increased from the previous year, and the overseas liability as a percentage of GDP has decreased from the previous year. So that is a good news. As well as So if you see, the ratio of net claims of non-residents on India to GDP improved. So if we see the net claims or the net IIP, this has improved from the previous year, okay, as a percentage of GDP. So now there is only 8.7% of GDP, that is the net claim, that is the net liabilities, we can say, okay. So the ratio of net claims of non-resident on India to GDP improved to 8.7% in March 2025. So basically the net claims of the or the net liabilities, we can say, the net liabilities or the net claims, they have improved from 10.1% of the GDP to 8.7% of the GDP, okay. So now let's see the composition of international financial assets and liabilities of India. So basically the overseas asset, we are investing in the other country, so the investment that we have done is the asset that we have, okay. So we have done the indirect investment, we have done the portfolio investment, we have done the other investment. Now other investment basically means the trade credits that we have provided. Let's say that we have exported the product to other countries. Now the Syria, or let's say the Iran, they are saying that they will pay after 2 months. So this is the trade credit that we have got, that this is the asset for our country, because we will get paid after 2 months with some extra amount, okay. So the export that we have done, we will get back the money after 2 months, okay. So the trade credits we have provided, we have given some loans, we have done the deposits in other countries, so these are the assets of our country, okay, that we are going to get back. Now liabilities is the investment that we have got, the foreign direct investment, we might have to give some profits to them, returns to them, or they might take their money back, okay. So the portfolio investment is also a liability, as well as the other investment like the trade credits that we have got. So let's say we have done some import and we have said that we will pay after 2 months, so this is the liability that we have to return, okay. The loans that we have got, so that is also the liability. The deposits that we have got, that is also the liability. So this is the liability side, this is the asset side. Now you can see that the total assets, out of the total assets that we have, the maximum is in the form of reserve assets held by the Reserve Bank of India, okay. So this is the idea. Now this is the basic idea, share of external debt and non-debt liabilities of India. So debt liabilities are higher in our country as compared to non-debt liabilities. Debt liabilities directly means the loans that we have taken or the debt instruments through which we have taken the money. So debt liabilities of our country is higher as compared to non-debt liabilities. Non-debt liabilities is the direct investment, a portfolio investment that we are getting, okay. Now coming to the last part, so this is the quarterly data from Jan to March 2025. Now this was mentioned in the newspaper, that's why I have brought this for you. But just remember the basic point, that means the reserve asset accounted for 58.7% of India's international financial asset. So here you can see that out of the total financial assets, out of the total external financial assets, 58.7% is the reserve assets. So reserve assets of the Reserve Bank of India accounted for 58.7% of India's international financial asset, okay. Next is the net claims of non-residents on India declined by US $34.2 billion during the quarter 4 of 2024-25 to US $330.0 billion as at the end of March 2025. So basically the net claims of the non-resident is declining, and it has declined in the quarter 4 also, and due to which at the end of March 2025, we had $330.0 billion of net claims, okay. So here the overseas assets is less than, the total overseas asset is less than the total overseas liability, okay. So there is the net claim of the non-residents, so that is $330 billion, okay. The net claim of non-residents or the net claim of the foreigners is $330.0 billion, okay. So now these are the two important points that you have to keep in mind, okay. The ratio of India's international assets to international liabilities increased to 77.5% in March 2025 from 78.48% a quarter ago. So basically the ratio of India's international assets to international liabilities have increased to 77.5%. So that is a good news that the international India's international asset to international liabilities have increased to 77.5%. Okay, so India's international asset to international liability has increased to 77.5%. So these are some of the important data points that you have to keep in mind. So now we are towards the end of the session and I will give you some homework questions, but before that, this is the perspective 360-degree series that is taken by Jaskaran sir, where you get the art of writing the answers. So you can get the answer writing practice, as well as here the current topics are taken, the hot topics are taken, that is quite in news recently, and that is important from the exam point of view, from the descriptive answer writing point of view in the examination. So these sessions are a must for you if you are doing the answer writing practice, or if you want to do the answer writing practice. So do go through the perspective 360-degree series on Monday, Wednesday and Friday at 5 p.m. Okay, so here you can here you get the current topics that are quite in news, and you get that what kind of question can come from this topic and what can be the answer, what are the pointers that you have to write in introduction, body and conclusion, as well as you get a homework question which you can write in the comment section below, and the answers get evaluated if you answer within 48 hours. Okay, so this is it. This is the first question. I hope you will be easily able to answer this question. So do try to answer this question. Okay, this is the first question for you all, and this is the second question for you all. So do try to answer this question. So this is it for today. Thank you everyone. Thank you for joining. And if you have any question, if you have any query, do comment down below. Okay, so thank you everyone. Thank you for joining. See you in the next session.